Welcome to Zen and the Art of Real Estate Investing. What if you could learn from experienced real estate investors, find out what got them to where they are now, get insight into their daily habits, and take these insights to inspire your own growth? Each week, Jonathan Green shares an in-depth look at the mindful approach to real estate investing. Jonathan is a real estate investor, advisor, and coach, as well as the founder of Streamlined Properties and the team leader of Streamlined Properties on Market, brokered by eXp Realty. Whether you are looking to start from scratch, get to the next level, or just a straightforward and honest approach to real estate investing, Jonathan seeks to provide a free mentorship program you can take with you anywhere. Now, here's Jonathan.
Welcome back. Yep. Another episode of Zen and the Art of Real Estate Investing is coming at you shortly. I just want to remind you before I get to our guest that one of the best things that you can do for us is to follow the podcast or subscribe to it. That really helps our numbers stay steady, and that also helps us grow. That means we already went from 1 to 2 episodes a week thanks to you, and we're just looking to keep increasing our production, maybe not in volume, but in a lot of other things that are coming soon. I really appreciate everybody who listens to the podcast every single week, twice. This week, my guest is Maxwell Wu from Fulcrum Lending. They are a direct lender for multifamily properties nationwide, and you're going to hear about why they're considered the digital lender for the modern investor. Let's go. This is episode 95 of Zen and the Art of Real Estate Investing with my guest, Maxwell Wu. Maxwell is the founder of Fulcrum Lending, a direct balance sheet lender for multifamily properties nationwide. He has underwritten real estate acquisitions totaling over $10 billion. Maxwell, welcome to the show.
Thanks for having me, Jonathan.
Yeah, I'm excited to talk to you. So when did you get interested in just real estate as a whole? I know you've been in prop tech and on the lending side, but when was real estate something that really became interesting to you for your business?
Yeah, I would say, I've been in real estate broadly for over a decade, and that really started in the private equity world, focused on distressed real estate in particular, distressed for control transactions. Started off in the fund management side, managing equity for, distressed funds, but also for bonds. And then ultimately, moved into the acquisition side. I really like the management side better though. And really, took an emphasis on understanding how to create, platform value, which is really all kind of a private equity fund is. It's another layer of leverage there.
Yeah.
So, that started about, over a decade ago. Since then, went into, investment banking and venture and company building, but it's always been with a focus to real estate. I think that's a really important thing too, is just, choosing one thing, focusing on that, going really deep. And, I often say, success in many things is a function of time. So if you're willing to put the time and the effort and to make that happen and to become an expert in it, good things will follow. And it's just about, trusting that process. So I've been fortunate enough to, have held positions that gave me a viewpoint, a vantage point, if you will, into very unique opportunities, and also just get to work with really smart people and understand how they think about investing and investing through multiple cycles, right? I think that we're at a very unique point right now where we are in the cycle. And, a lot of people are just trying to figure out where things are, right? I think many folks in active management allocation positions, they may have seen, 2008, 2009 from afar, but, I think the prior cycles, tech bubble, oil crisis, 80s, those are all really important data points that one must factor in understanding how, the overall investment, let's call it the investment world, overlays on top of just, the sticks and bricks of it, right? The real estate is the fundamental value piece of it. And that's what I've always been focused on, is the fundamental value there.
Yeah, I mean, that's something that now is even more important, like you said, because it's been a little bit haywire, rates are high. So there's other things to focus on right now. Are you finding that, like, obviously, I know we know the answer to this, but multifamily transactions across the board are very much down right now.
Mhm.
Is it fully in effect just because of the rates, or are there other things at play with buyers and sellers not meeting on price and value?
Yeah, I mean, I think, to your point, yes, bid-ask spreads are still very wide. But, part of where we are in the lending world is also a function of where equity thinks, prices will go, right?
Yeah.
We're cash flow based lenders, right? We're looking at the asset, we're looking at basis, we're looking at the debt yield being thrown off the property. That's all really important. But, it's just about what's holding the seller's feet to the fire to make them transact, right? I think going back to, even in COVID, right, rates ended up cratering. People took out a lot of floating rate debt. They purchased rate caps. Those things are burning off. They got into loans that were, full term IO or partial term IO, and those are burning off. So that's bringing people to the table and forcing some transactions in. But I think for the other half, right, that have some duration, some longevity on the debt that they have, that have longer term patient capital, those ones will continue waiting to see kind of where the world ends up settling. Because, real estate, there's a camp, right? And I'm in that camp where I think cap rates really do follow interest rates. So if you're a real estate person, right, you really do have to be following the markets there. I'm not saying that, put an overwhelmingly weighted position on that. But for the most part, markets do play a large role in where value is, right? So if I think fundamentally intrinsic value for a property is at X and the market thinks it's Y, right? That's the reason why there's that spread, that bid-ask spread. Yeah. But as, there's a reason for people to come to the table, then transactions will happen. The thing is, right, compared to the last crisis and the crisis before, the fundamental underwriting, the fundamental value in a lot of these assets, it's a lot stronger. There's just a lot more data, a lot more experience, a lot more regulation, frankly, that goes into forcing people to underwrite more responsibly and with a little bit more sanity in what it actually costs to operate these things and what you can actually push rents to.
Yeah. Yeah, like if we just go back, can you just explain what floating rate debt is? Because it became so popular and now it's become the real problem where that's where, where people are looking to hopefully transact on that. Why did people choose that? What is it? And how is it affecting the market now?
Yeah, I mean, floating rate debt is, it's a variable interest rate you're taking on as a borrower, right? The intrigue is that, you can borrow at a lower rate today, but the trade-off is, okay, you don't know where rates are going in the future, right? There's two sides to every trade, right? And there's an opposing viewpoint on someone selling versus someone buying, right? So taking on floating rate debt, it's attractive for those that kind of need short-term bridge and are willing to kind of take on that risk of, duration. And say that they can confidently, take a property, improve it, push rents, and refi into a fixed rate loan at a higher valuation, right? That's the reason they're getting into variable rate, floating rate debt.
Is it the same as like for regular home buyers, adjustable rate mortgages, or is it different? I mean, is the floating debt a little bit even more risky than ARMs? Because I don't consider ARMs to be that risky as long as you know when you're going to leave. But I think that floating debt might have a couple other things going on.
I mean, I wouldn't say it's any. I mean, if you perceive resi floating rate, these ARMs, as not too much risk, then I would say that transfers similarly over to the commercial side. It's just a larger property. But I mean, our viewpoint is, we don't want to issue that. We don't want to put borrowers in that potentially precarious position. We are fixed rate lenders. We're also big believers in not overburdening the property, right? We don't want to charge exorbitant interest rates where it immediately puts the property underwater day one, or where the DSCR, the debt service coverage ratio, is below a 1.0 or 1 times coverage. So we're not in the business of loan to own or taking keys back there. We very much want to just clip a healthy rate of return and go home, and make sure that our borrowers or sponsors are responsibly implementing their business plan and more importantly, successfully implementing.
Yeah, that sounds more collaborative than I guess what people would think of like most traditional straight lending, not really involved in the product itself. Is that something that was important to you, kind of moving in to make it just a little bit more collaborative and I guess safe for everybody involved with less hassle?
Yeah, exactly. I mean, that's what it is. I think lending, capital markets, I think just real estate broadly, it's a very long-term business. It's a relationship business. You got to make sure you do right. You want to make sure that you're not in those hairy positions. And, again, one can take the opportunity to be opportunistic in lending here. But again, fundamentally for us and kind of our guiding ethos as a business is, work well with others and you can continue working together in the future.
Yeah.
And that starts with, the very first deal you do. So, doing that every day in, day out is important. But, all those kind of things, all those factors go into, why we offer certain products the way they are or structured products the way they are right now.
Yeah. No, I like it because, this podcast is about the mindful approach to real estate investing. And this is like thinking about it in a little more in-depth way, which is like generally going to be more of a win-win for all parties involved. And that's where I think, like, especially for new investors, but if new investors, even if they have a lot of money and they want to go big in multifamily, like they could get, in trouble real quick with floating debt and all the other things that are surrounding it. It's interesting. So when you call yourself direct balance sheet lenders, that's obviously more focused, I guess I would say, on the data. Why is that different than other multifamily lenders? And how do you guys differ in that way?
I mean, I think the balance sheet portion, there's a lot of balance sheet lenders out there, right? I think just lending, if you want to just zoom out further with, and think about lending broadly, right? It's a financial product that's being created for a borrower to take cash and again, implement a business plan that they see as suitable for that property. And then there's investors on the other end that want to receive that coupon, that rate of return for lending that money, right? That's us. I think the biggest thing that differentiates us is, yes, that collaborative aspect to it. We're lending at close to a 1.0 DSCR as is, and that's based on in-place cash flow. So to do that in a productive way, in a successful way, you have to be able to work with the borrower and also kind of see into the future with them, right? They're going to tell you all the things that, they see in the property and the value that they perceive in the market. But if you're a lender, based here in New York, how do you get smart on real estate down in Florida, down in California, down in Texas? Well, data certainly helps a lot there. So, the second that we make contact with the borrower, we're really getting smart on the actual market and the property and the sponsor so that we can speak to that opportunity in an educated fashion and let them know that, hey, for example, rents have been growing at 5% over the last 3 years, right? Why do you think that it can grow another 5% in the next 3 years, right? If we have the same data and we can extrapolate that, then it's a little easier to understand, right? If we don't have that, then we're kind of going in with a little doubt and saying, well, prove it to me, right? So there is that collaborative aspect that enables us to come to the table, with some value too. And it could also come in the form of a borrower saying that, they can reduce expenses by X, right? And we're taking a look at all the proximate properties in the area within, that's called a 0.1 or a half mile radius, and saying that these properties cost Y to operate. Why do you think you can bring it down this low? And then they'll often come back and explain it, or they'll say, you know what, that's something we missed. Thanks for catching that. And then we kind of go on from there, So, data does play a large role in how we think about valuation and how we can get comfortable with the risk that we're sitting on. Because again, we're sitting on, a 1.0 DSCR.
Yeah. Let's just talk about underwriting for a second, because I think like obviously on the lender scale, it's something obviously you're doing to qualify the loan and the participant. But I feel like investors sometimes don't take underwriting as serious. Obviously, like you're very experienced investors, they know how to underwrite. But why is underwriting so important, especially on these multifamily assets? For these newer ones, even like we said, they have a lot of money, they want to get into large scale multifamily. But like if you don't understand the underwriting portion, you could miss something that could take you 20 years to fix, right? On these buildings, they're so big, so many units.
Yeah, I mean, I think I heard your question right. Kind of why underwriting is so important, right?
Yeah, well, like all the ways that people can mess up.
Yeah, I mean, exactly. I mean, you miss a unit, right? You mess up you fat finger the occupancy, you fat finger something, right? Maybe the data's imperfect. Maybe the data that you're getting from all your other OMs, massively overstate rent and really massively understate expenses, right?
Yeah.
So it's, good data in, good data out, right? Bad data in, bad data out. So it's really focusing on the quality there. But I think in terms of just fundamental underwriting and, just kind of spot checking or just making sure you're doing it right, looking at, properties in the proximate area that, are having expenses, at an average rate of X versus Y, right? That'll you understand that. But yeah, I mean, underwriting is fundamental. It's value follows earnings. Earnings is our NOI, right? And if that NOI doesn't happen to be the number that we initially underwrote, it's kind of like a stock, right? And if you read, your same financial news, you hear Microsoft misses X earnings, right? Their stock tanks, right?
Yeah. Right.
Similarly, right? That's the same with real estate values. All of a sudden that, your earnings actually don't match what was projected, right? It's a really massive hit to value of the property.
Yeah. I also think like with the, rapid advancement of technology, people can make a deck look real nice. It doesn't mean that the numbers are actually correct. So that's what they need you guys for and everybody else looking in the background, because like anybody can make something look phenomenal.
Right.
Every investment can look amazing. Swampland, all of a sudden like, wow, the return looks pretty good here. But you guys are all seem like working together to make sure like this is an asset that everybody should be collaborating on and that you're willing to lend the money on.
Yeah, exactly. I mean, there's one element where it's just about pricing risk appropriately. And I think in this last cycle, if you really want to, I mean, you think this has been a 10-year bull market or plus, it's really been probably 20 years. If you think about it from where interest rates were to where they are now, interest rates drive a lot of value, right? When rates go to zero, you have to go way up the risk spectrum to get a return, right? So it's less about assessing risk and it's more about chasing yield, right? So I think that's just another huge part with underwriting is very much understanding risk, right? Understanding it very, very fine to a finite level where you're pricing it appropriately. And, it goes kind of full circle into the whole, interest rates, where they are, how that impacts investor behavior.
Yeah, I really like that, because I think risk assessment is something that everyone needs to get comfortable with, because I find real estate to be like a very stable asset, balancing it against stocks and crypto and NFTs and things like that. But there's inherent risk in anything. And to be able to get comfortable with that risk, like you said, that is really underwriting. Are you okay if X, Y, and Z happens? Do you think that it's important, even on these multifamily assets, to understand what all of your exit opportunities are as well? Especially like if you're taking out, loans that are going to potentially fluctuate, you need to know that there's other options for these properties.
I mean, absolutely. I think you should be hyper focused on your exit. Being wholly dependent on a single exit is tough, right? And say, I'm going to refi out this thing, it's going to be easy. Yeah, that is one option, but that's one option.
But isn't that what happened though with a lot of the floating rate debt? They were like, oh, it'll be no problem, I'll just grab it, in a few years, and then it's like, oh, now we're in trouble.
Yeah, I mean, look, it's kind of like a really deep hole you can dive into. The central bank, I think a lot of signaling has come that rates will eventually rise, and finally they weren't crying wolf, and it actually happened. I remember when they started raising rates in, was it 2016 or 17, right? Commercial real estate was just like, oh my God, what's going to happen? Well, rates actually ended up reverting backwards. Market ripped up again. People that sat still kind of regretted that decision. But again, that's kind of, it goes into, there's so many reasons for that, right? It's people who are listening to the central bank and understanding, why and where things would go. But then all of a sudden them reversing course kind of was a little bit like crying wolf, right? So it's hard to believe them now. But I think that, fundamentally when you look at just the global economy and the U.S. economy versus then, is that, the amount of money supply that was put out between then and now, every $3 in your pocket, one just showed up. That's money printing, right? And what you do with that dollar is impactful to the global economy. And that's kind of the reason for this inflation, right? And if you're looking at inflation, they've got to raise interest rates to suck some of that liquidity out while continuing to maintain stable employment. So it's a tricky job, right? But when you print, again, 1/3 of all money printed in the last 3 years, it's a little bit different. It's a different equation. It's a very, very fundamentally different equation. So with that, right, I still do find solace in being on the lending side and, continuing to make a steady return, not being wholly dependent on price appreciation, but rather yield generation just from cash flow, right? And those are just two different ways to look at, how to approach value.
Yeah, and I know this is something that you probably know a fair amount of, but it seems like debt has become extremely popular as almost an asset because of the way this market cycle has come. Is that something that you're seeing a lot, that people are more interested, even real estate investors, they're interested in investing in real estate debt during this time where the deals aren't out there?
Right. I mean, it's certainly been an approach, and the calls and the meetings that we've been fielding, the sentiment has been, I think a lot of equity investors think there's going to be some type of correction, right? And you want to take advantage of the correction. You want to get the best deal possible. But again, going back to there being ample money out there, and when rates do come back in, and they will, there will be a flood of money rushing in. If you think back to even, SVB, right, just recently this year, they're having a fire sale on their assets. And a lot of private equity, a lot of private credit, a lot of just, folks with investable dollars wanted those assets.
Yeah.
Very few people get the call. I think that's a really important thing to remember too, is that when there is so much dry powder on the sidelines, right, there is a lot of opportunity that will be snapped up very quickly. And that's going to make that cycle very quick, right? And that's very much a V rather than a U-shaped recovery. I give that context to say, the approach has been, why don't we just get paid to wait, right? And why don't we just put money into these loans and take a rate of return home, right? And it would actually be the same rate of return as their cash on cash would be in years 1 to 3 of the deal anyways.
Yeah, right.
So that's kind of the arithmetic there. And they're saying, okay, this is kind of the same returns I'm getting, right?
Yeah.
So short answer, yes, there's been a lot of interest and people coming to us for, partnership opportunities and trying to co-invest in some of these things.
Yeah. Hey, this is Jonathan. Thanks for listening to another episode of Zen and the Art of Real Estate Investing. On this brief interlude, I wanted to tell you that we have a mailing list. I actually don't love mailing lists. There's so much. This is not an automated mailing list where you get on a drip campaign. These are written once a month, will eventually be at once a week again by me, direct, and they're not spammy. So if you want to sign up for our mailing list, you can go to bit.ly/streamlined with a D mail. Bit.ly is bit.ly/streamlined mail. See you there. Well, let's talk tech a little bit, because your platform at Fulcrum is very tech focused. I mean, were you finding that, is multifamily as a whole, obviously there's old school type lending, and this is something like new that you're trying to make things easier for larger scale real estate investors, right? So tell us a little bit about how much you focused on the tech and why you think that's an enhancement for your platform compared to what kind of like regular lending does.
Yeah, I think our technology gives us an edge in every part of the business, whether it's from the origination level to the underwriting level to the diligence to the servicing, right? Even investor reporting for investors, right? Our technology helps us every inch of the way. Going back to just even having the conversation with a borrower in Florida or Texas while we're here in New York, again, how do you get smart on an area really quickly? Especially if it's a secondary or tertiary market, right? One phone call with our originators are able to input the address and pull up all the information on the market and how much it actually costs to operate the property in the area and how much rent they've been achieving and what that growth rate has been, right? So immediately on that call, they can add value, right?
Right.
I think adding value day one is what it's about. And you want to be able to give, right? And eventually, right, once that value is recognized, then there's this trust and confidence that's developed between those two people. And again, I refer to them as people because it is a very people oriented business, right? I don't think just a company and a company. It's it helps them develop a relationship because now you're talking to someone that's almost like a peer, right? And the technology ultimately is what allows us to do that. It allows us to be immediately informed. And then when you move to the underwriting side, right, we pull comps on, nearly 60% of the multifamily in the country. And that allows us to have a fine, detailed level, property level, expense line item level vantage point into how much it actually costs to operate. So we're doing a fundamental ground up, bottom up valuation of property. And that's exactly what our sponsors are doing because they're the boots on the ground. They're the ones that know it, right? So like the example I mentioned earlier, right? We can often come in and say, hey, I think expenses are actually a little low here. And they'll check it back with their numbers and say, oh yeah, thanks. Or the tax number, especially now insurance numbers. Insurance numbers are crazy.
Yeah, you mentioned Florida. Like that is a big deal though, because you have to stay really updated with what's going on in insurance. Because you could have someone from a year ago just think like, hey, Florida seems awesome, looking at their year ago rates for insurance and not realizing they're going to be like, 2.5x on that now. And that changes the whole equation in 1 second.
Yeah, exactly.
Yeah. I was thinking exactly what you just said. I was thinking of what you said before about a client on the other end saying like, wow, okay, I missed that. And then they're able to factor it in. And that's the collaboration. And I've always said something that you said too, that like real estate people think of it as like a financial, versus asset, but it's all relationships because everything that you do inside real estate comes from building a relationship. Most of the properties that you find, the better properties you find come from people that you know. And this seems like, just like I said before, more collaborative, which I kind of have wished real estate investing would be. In your experience, I think that sometimes new investors look at real estate investing as like a very competitive field, but I don't think it can be competitive. There's real estate everywhere.
Yeah, look, it definitely attracts competitive people.
Yeah.
And that's a good thing though, right? It's good to have competition. It makes people better. It makes products better. It makes process better without competition, right? We're kind of forced to do the same old, right? That's really not what we're here to do. But yeah, and the other side, right? We take the approach of almost real estate as a commodity as well. In terms of evaluating these properties, if you have 3 properties kitty corner off from each other, even assuming that they have the same lot coverage and all that, right? If someone were to put laundry in one one building and all three didn't have it before, right? The other unit's going to go buy laundry units and put it in, right? Same thing with maybe trash, pickup or dry cleaning, these other amenities, right? And, when it becomes so plug and play, and I think, there's a lot of prop tech services that allow this, that almost allows this easy kind of vendor, sponsor collaboration to increase that value. Because I do believe, right, if you can increase value at the property where that cash flow is really exclusive to that property, you can't get that cash flow anywhere else, right? That value associated with that cash flow should be valued like real estate, right? But point being is that's oftentimes forced this almost commodification of it. And the way we look at it is, okay, if in the worst case scenario, right, we don't hope for this, but in the most draconian sense, would we be able to take the property and sell it, still take our dollar back, right? That's the reason why we're in the credit business, is because I want to put a dollar somewhere. I want to reliably get the dollar back and some more for the time that I didn't have access to it, right? And again, in the most simple sense.
Right.
But yeah, I mean, there's an element of commodification that's certainly developed. And I think in commoditized businesses, it oftentimes attracts very competitive people, because then it's ultimately this game of wit and maneuvering and trying to figure out the better structure or whatever that may be. I don't know. That's a take on it. I'm not saying it's the take.
Yeah. I also want to talk about cap rates a little, because it's really all investors are going to look at cap rates on your large scale multifamily, but they've adjusted so dramatically in some areas. But it's very hard for people to say, like you were saying before, that cap rate, you could track it with inflation as well. But what have you seen in terms of cap rate, and is it still a viable way? I mean, people have to use it to evaluate, but how much differentiation is there really is, or is it just a product of the way that the market has moved and the interest rates?
I mean, I think short answer is yes, it's still important, but then there's certain times where it's less important, right? And I think in times of high volatility, it's kind of hard to put a multiple there. At the end of the day, there needs to be a measuring stick of sorts that everyone can agree on, that, there's 12 inches in a foot. Now, cap rate's kind of like that function. It's just saying this is what the value of real estate is. But in these times where, the benchmark that, again, if you're in the camp that it's correlated to interest rates, if that thing is moving like in major ways, it's kind of hard to say that real estate's worth, 9 million today, 10 million tomorrow, right? We're not in it because it moves like a stock, We're in it because we see long-term intrinsic value there. So that's where, in these times, right, in addition to cap rate, right, you want to focus on creation value. And that creation value is ultimately how much does it cost to actually develop a similar product in a similar area to get the same return?
Yeah.
It's almost this back to basics of, again, a focus on the sticks and bricks. And I think if you have a firm grasp of what that creation value is in any particular market, and then also kind of what the growth prospects are, right? And you focus on that and you get rid of the noise, you're going to make a really good investment.
Yeah.
Because this whole idea of efficient markets, we all know that's a farce, but we do know that markets strive to be efficient. And that's what makes a market, is that people constantly striving to hit that point. But that's just to say, is like you need to have, you have to have a pulse on fundamental intrinsic value in volatile times. In less volatile times, I think you can rely on the measuring stick. But for now, it's kind of like going analog and kind of weighing your own stones.
I like the analogy, though, because I agree. I think you have to have like an agreed measuring stick, but it's not going to, like you said, you can't put the same reliance on it right now. What about like wide scale commercial vacancy? How is that having an effect on the lending business and then the multifamily game as a whole? Because there's so much vacancy in commercial that then it's much harder to sell, because you're looking at pro forma possibilities instead of established rents. And I don't know how much that affects on the lending side, but it seems like it would be an issue now.
I mean, commercial rents, right? The extent that we have exposure to that, it's oftentimes on the retail side. So there's we'll restrict retail or commercial income to being no more than 25, or maybe on the higher end 35% of total income or total revenue from the property. So I mean, I can speak to more of the retailing side, and I think consumer spending has been strong, and there's certainly been a large rebound there. And you can also track that with consumer credit, right? Credit card debt outstanding. It's a worrying number, but spending is strong. But we're not underwriting the same cap rates as multifamily to that, right? There's a different level of value that we're taking to that.
Yeah. I guess, I mean, like multifamily vacancy is low, but I think I was overall thinking of like commercial vacancy. I mean, just San Francisco as a whole, where I look at the statistics about available commercial space, and it's like, well, how are people going to lend on this when it's just vacant? Multifamily is fine, but like, I do worry about commercial in general. Is that something that you guys also take a look at, just in terms of, because those buildings eventually, some might get converted, there's going to be some hybrid conversions along the way because there's not going to be uses for all of those buildings.
Yeah, I mean, I think certainly doing a pro forma financing, that's not the business that we're in. So
Exactly.
I can't really speak to that. But I'm sure
But that's important though, because like that's my point. It's like you there's no way to really value it, because what the value used to be isn't the same after the pandemic for that type of commercial building also. Mm-hmm. So it's like, what are you coming up with? How are these things going to eventually get sold? Maybe hopefully they're turned into multifamily if it's possible.
Right. I mean, there's been legislation passed to help with the transitioning of commercial buildings into multifamily, but again, if you're a sticks and bricks guy, you're going to know that the building, the envelope, it looks good from the outside, but once you crack that thing open, right, everything, all the inner workings of the building are completely different.
Yeah, I know. I mean, that's the problem. There's cement. You can't just one bathroom a floor into a bathroom per unit. It doesn't work that way.
Yeah, I mean, even thinking about the most humane aspect of light and air.
Yeah, very, very true.
These huge, floor plates where the center of the floor plate, there's nothing there. No light gets to it. That's a tough build. That's a tough property to sell. So there's an element of like the shape of the building having to make sense. I'll digress from there. I can only speak so much to that.
Yeah. So in terms of like multifamily, and when you're talking to, new clients, existing clients, what do you think the biggest misconception for people who are looking to buy large scale multifamily? What's the biggest misconception they have about, getting loans on them or lending in general on those buildings?
For the most part, the biggest misconception is lenders, I guess, view of value being drastically different from theirs. Yes, they are looking at their own underwriting, their own cash flow, and it's not that we don't believe their pro forma or whatever that may be. But there's this element where we're looking at multiple exits, and we're looking at how do we get our dollar back, and we also got to look at what the market looks and values that property in the future. And if there are certain, let's say, tax abatements, there are certain special allocations there where, they can renovate a property cheaper than, the next guy because they have their second cousin turning units, right?
Their own crew, yeah.
Right? We can't recognize that value, right? And again, we have to look at it in the sense where, okay, worst comes to worst, can we actually operate the property at the same level that they are? And if we can, then okay, our view on fundamental value will match. But without that, right, it's kind of hard to say that we see the same value because I don't have the same access to your Uncle Sal if things go south, and he's not gonna come turn units for us, So there's that more practical element there. That's where borrowers on especially new borrowers in multifamily, because they're looking at it and kind of looking at it like a single family, like they bought one down the street and saying, hey, I can actually just drive down there and, if something's wrong with the sink, I can actually pop in and fix it. But on the commercial scale, it's not like that. It's like running a business, and you got to have, licensed professionals do it. You have to have responsible management there. You got to be present. You have to address the issues on time. And it's less of this kind of do it on the weekends type of thing. It's very much at scale. And this is the other part is, you have other people's lives in your hands. You're in a 300 unit property. There's 300 families, lives. These are all different people that you have to care for. And that's the other side is, like, we're not going to be the police on it, but we're going to say, look, you as sponsor, as landlord, you do have a responsibility to maintaining these things at a certain level, a livable standard that every human, on this planet deserves to have.
Right. Yeah, no, it's a good point. I can see where people just kind of want to get it done. But, as a lender, you're trying to protect your money that you're loaning out and make sure that the investment, like you said, you can get that dollar back if you need to. Preferably, it just all goes well. You get your regular returns. Everything goes fine. Value increases. Everybody's happy. But, as we go through these market cycles, we realize, it doesn't always happen that way, depending on the debt that people put on or how desperate they are to get the debt in the beginning.
Mm-hmm. Exactly.
So do you if you had your own crystal ball based on your experience, where do you think the next year for multifamily is going? Should people have some hope that it's going to get a little bit better and that buyers and sellers may actually get a little bit closer on the price? Or are we still going to be in this wide gap where the properties just can't trade because nobody can agree?
I mean, specifically for multifamily, right, that subsect of just commercial real estate broadly, I can speak to that where, we see pending maturities coming, right? Multifamily commercial loans, right? These are 5, 7, 10-year loans, right? They're not 30 years. So you gotta have your finger on the pulse on where the markets are so you can actually either roll the loan or pay it off either by refinancing it or selling it, right?
Yeah.
But I mean, I think the biggest thing is just what's forcing sellers to the table, right? I mentioned interest rate caps burning off. I mentioned interest-only loans going amortizing. Maybe some properties are at the end of their business plan, end of the life of their business plan. Whatever the reason is, there needs to be something to bring the sellers to the table. Otherwise, right, if they have long-term, locked out debt that they don't have to worry about refi, just sit there, clip a good cash on cash. Know that inflation, right? Real estate's a great inflation protection, and that your value will be held, right? Maybe you're not going to get that increase, but I think, right, going forward, I think the market's going to be, sideways. I don't think it's going to rip upwards immediately or even, in the next 12 months by any means. I really do think when you track, money supply, inflation, how much needs to be sucked out of the system, it's kind of just pointing towards this kind of flatlining in the markets in terms of growth, and that interest rates will be higher for longer. But we're also saying that in the best case scenario for everyone, interest rates come in, right? Well, okay, that's good for our loan portfolio, right? Because as interest rates go down, your bonds go up, right? So that's a good position for us to be in. But it's also a great position for the borrowers, the sponsors as well, because now they can refi in a more stable market and be able to achieve the cash on cash that they originally planned for.
Yeah.
But I mean, if I don't have a crystal ball, I wish I did. But
I wish we all did. Yeah.
If again, from my position is unique as a lender. I see if the market continues, going sideways. Again, we're happy clipping our coupon, making the same returns that we would otherwise in a value add deal. But in the best case scenario, right, market comes back and we're back in the swing of things.
Yeah,
but
it's going to happen at some point.
I mean, famous last words, right? I don't think there's going to be a giant fallout. I think
I agree.
Going back to fundamental value in the market, it's strong. We look at the loans in the market right now. We look at how they were underwritten expense-wise, rent income. Multifamily, that's why we only do multifamily, is that going back to, being focused in one thing and doing it really well, it's a special asset class for us because it's, people do need a roof over their head. If they are going to cut spending, right, they're just not buying catalogs, they're buying, whatever the generic grocery store brand is. And there's all these other cascading cuts that you can take in your life before uplifting and moving your family out of your home, right? So that's kind of the last thing to change. So, that's also why we are able to be so much more, bullish on real estate, especially with these headwinds, and just saying that, okay, if things do get worse, we're still in a good position because people do need multifamily real estate, roof over their heads. And, there's just that fundamental need. So I didn't really give you a great or answer.
No, that's perfect.
It's not really a quick or concise answer, but that's how we look at it. And I think that's possibly the best.
I think it gives everybody like a very good overview of what multifamily investing is, though, because it's an asset that's so important, with affordable housing being harder and harder to get. Multifamily is the thing that can bring the affordable housing or just more housing options in general out there. And that's obviously why people are going to need to be building more of it and then financing more of it and figuring out where it can go.
Yeah, exactly. And there's really a slew of other reasons, right? And when you look at these interest rates, right? You look at new supply. I know new supply has been a huge conversation, but with interest rates this high, people don't want to take construction loans out. So you're kind of stopping this new supply, which kind of further puts you in a good position if you're in multifamily investment already versus in the future. Like I said, list goes on there, but multifamily is core to the economy. It takes up a third of the consumer wallet. Roughly, folks spend at least 30% of their gross income on shelter. So that's a huge amount. It's a necessity.
Yeah, absolutely. All right, Maxwell, is the best place if people want to get some information about Fulcrum is fulcrumlendingcorp.com.
That's right.
And to get in touch with you, is that the best place to find you as well?
That's right. There's multiple forms of contact in there, and then you can also go ahead and create a profile if you like, and that way you can also do your own underwritings, leverage our technology and data to help you get smart on any new area that you may be investing in or want to be growing into. That's how we use it, and that's where we get a lot of value. So we want to also be able to provide that value to the folks coming to our site and coming to us for loans.
Yeah, I would just say I've been on the site. Like, this is a really good site. I think it's like highly informative, but I think it also is like it's kind of fun. Like it looks like there's a lot that you can accomplish with Market Screener, Market Insights. So I encourage everybody to head on over to fulcrumlendingcorp.com, see what Maxwell's got going on over there. Maxwell, it was a pleasure. This was definitely a high-end episode. I hope people followed the whole way through, but it's great information and it was great to meet you. I appreciate your time.
It's great meeting you too, Jonathan. Thanks for having me on.
Yeah, all right. That was Maxwell Wu. I'm Jonathan Green. We'll see you next week. I hope you enjoyed that episode of Zen and the Art of Real Estate Investing with me, Jonathan Green. And I just want to remind you, and this is always an uncomfortable part, I don't want you to think that I'm begging for you to like, subscribe, follow, do whatever you have to do for the podcast, leave a 5-star review. But if you like the podcast and you think it adds value in the real estate investing sphere, then just do me a personal favor. Like the podcast, follow it, share it when you can with your friends, and be so kind as to write a 5-star review if you believe it deserves a 5-star review up against what else is out there. I would really appreciate it, and I hope you keep listening.